Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields creeping higher. We got about as high as we did last week, almost. We didn't quite get to 285 in the 10-year note yield. We got to about 283 and change, and basically the market seemed to sigh a relief, whether it's the conflict in the Middle East or whether it's trade war talks with China, U.S. data or expectations for earnings. There's a lot of sighs of relief here. We saw treasuries kind of come down and yields rise. We saw gold sell off. We saw stocks rally. So it was kind of one of those risk on days, and treasuries just didn't seem to. They were back in that old range, not really pricing in any kind of major fear. Still kind of coiling and waiting for something. We've been stuck in this 280 to 290 range for quite a long time, outside of the last several sessions where we did dip below 280, but never really threatened to push down to a key resistance of 265 yield. And now we're going to kind of start talking about the 3% game, 3% yield target again, as if it's going to come in the next few weeks, and it probably won't. We still have a lot of things to get through over the next several weeks before we get to the key data, which could take us there, and that's advanced first quarter GDP, not until April 27th. And if you look at volatility, yeah, it's at the low end of the range. It kind of seems very ho-hum. Obviously things are calming. The markets are excited. Stocks rally. Everybody sighs relief, and volatility just goes down. And I think that's been the trend in treasuries. The VIX is very elevated despite the fact that stocks rallied. And yeah, it comes off from time to time. But if you look at the VIX from this year to last year, equity volatility much higher. Treasury volatility, not so much. And we continue to see treasuries lag in the volatility category, and eventually that's going to catch up with it. But right now it seems that the market is very content to remain in that range, 280 to 290, as evidenced by lower volatility. And if we look what's happened and what's ahead, well, we had supply this week, and if you look at historically when you get issued, you get your monthly supply of 3s, 10s, and 30s, it tends to boost up the yields a little bit as in anticipation. That didn't really happen this week. Yeah, we saw them nudge up a basis point or two, but nothing that I would say is significant. And they were very mixed. We saw a very poor 3-year and 10-year auction, followed by what would be considered a pretty strong demand 30-year auction today. And I think that the kind of the mix just left us wondering if the supply game that we heard all about with the Fed not buying and looking for buyers out there, and foreign central banks maybe easing back on their treasury purchases, it really hasn't had an adverse effect. So again, we're back into that range where volatilities are low. Supply isn't really having an effect on markets, not driving yields higher as one would expect. But again, we have what's coming ahead. And tomorrow's focus, I think, will be all about earnings, bank earnings. Bank earnings could be the key here because they will set the tone for the rest of earnings season, really, when you talk about Wall Street banks. So I think right now we're expecting strong earnings from the banks. If you talk about maybe the easing back of Dodd-Frank, that could actually help opening up some more avenues for banks to make more money. That would also be good. So banks right now coming in tomorrow will start some of the key earnings that we'll see. Likewise, into next week, things will start to get a little more colorful on the stock earnings side. The bond market, which has been very, very reactive to what's happening in the stock market, will continue to do so. So look for bonds to trade off of what stocks do. Stocks rally, bonds should probably sell off a little bit. Stocks fall out of bed, and you probably should see bonds rally a little bit. But again, as the stock market sees these 2, 3, 4% swings, the bond market sees very tight ranges, and it doesn't really see a whole lot of emotion. So right now the bond market's still waiting for that it moment. I anticipate that to be the growth numbers that we get at the end of the month, or something that maybe comes out of left field that nobody's got on their radar. But for right now, we're back into neutral, low volatility, with earnings maybe going to change a little bit of that, doubtful, but it certainly will have an effect on the stock market, and the bonds will track that. This is Todd Colvin coming to you from the floor of the CME Group.